Michael Gomez, and I'm a real estate broker and an investor here in Nashville, Tennessee.
And I'm Seth Mosley, Grammy Award-winning songwriter and real estate investor.
We host a monthly meetup in Middle Tennessee for anyone who wants to build passive income, not only for retirement, but for today.
On the first Wednesday of every month, we bring in an expert from every area of investing to help you with things like finding deals, getting your financing locked in, asset protection, every kind of investing, so much more.
Our videos are all about delivering that content to you.
Go to musicandmoneyig.com for more info on our free monthly events. Hit subscribe on the page so you don't miss any awesome content, and hit that like button if you like it.
Don't let all the flair of my jacket distract you.
Here's the content.
This is Chris Picciurro right here.
Thank you, Michael. All right, good morning. Good morning. My name is Chris Picciurro. I'm going to scooch this over. Thank you for coming out this morning. Thank you for everyone watching on Facebook Live. I want you to know that we will be emailing this presentation out to anyone that is interested. So just take a deep breath. We're going to go through a lot of information. This tax reform presentation is like an accordion. We could make it 8 hours long, and we're going to squeeze it to about 40 minutes to leave some time for questions. We always have time to explain how this reform will affect you personally, and also understand that there are resources that are linked to the end of this presentation that are free for you to utilize to figure out how the reform will affect you personally. I'm with Integrated Financial Group. I run our CPA side, which is called Integrated CPA Group, and we help about 4 different types of people that we call are in our ecosystem. Self-employed people, business owners with 100 employees or less, anyone in the real estate business, including investors, property managers, realtors, and then also highly taxed households. So if we can make an impact on their lives, if we could do one of the 4 things that we like to do, which are reduce your taxes, help grow your assets, preserve your wealth, or mitigate financial risk, we're going to do that for you. But this presentation isn't about our company, it's about tax reform. And again, I'm going to get through as much, or I'm going to make this pretty expeditious, but again, I don't want you to feel like I'm rushing you through this. We've highlighted the things that specifically real estate investors would be interested in, and I'm going to spend a little more time on that. Here's our agenda. We pretty much did the introduction. We're going to look at tax reform from a 30,000-foot view. I didn't get that West Haven chopper. So, Michael, I don't know. We're going to have to increase the sponsorship fees, except for ours, of course. They're very fair, though, and it's an honor to be here. But I didn't get the West Haven chopper bringing me over, but that's all right. We got here in one piece. So we're going to look at things from a 30,000-foot view. Then we're going to look at 3 different buckets of how the reform affects different groups. One are C corporations. I'm imagining that most of the people here and most of the people watching really don't use C corporations very much. So we're going to, and there weren't that many changes with C Corps, but we're going to touch on that. Then we're going to look at how things affect individuals, and I've picked out the most important changes to individuals and also how those affect real estate investors. Then we're going to talk about small business, self-employed, and pass-through entities. That's most of our client base and most of the people here. Even if you have a W-2 job or you have a primary employer, if you have rental properties, if you're involved in flipping activities, then you are what's called a pass-through entity, and that's where the most significant change occurred in tax reform. Then I'm going to give you some planning opportunities, and then we'll discuss some resources. I've been doing this a long time, and that's some information about me, but I've really been involved with real estate organizations. We do presentations. We've done them in several countries, 3 continents, with the National Association of Realtors, National Association of Residential Property Managers, but this one is extra special because it's in my adopted hometown here in Franklin. So I always make a joke that when we go to Hawaii, or we're going to go to San Diego and actually do this presentation for a large real estate organization, I say, well, I flew here from Tennessee, so you must think I know what I'm talking about because I came from far away. So since I came from 4 miles away, they were pretty desperate, but that's all right. So from a 30,000-foot view, please understand that tax reform and tax law is really it's really an arm of what our government wants you to do and actions they want you to take, be that investing in certain pieces of property. And how they make the rules and how they enforce the rules is just trying to get society in general to do certain things, like either have higher home ownership or invest more in commercial real estate or pay dividends to their shareholders. So it's really a political theme. And luckily, and I'll just touch on this, I had the opportunity, I'm part of Intuit. Intuit owns QuickBooks, Intuit owns TurboTax and the software that we use. They're responsible for over 40% of all the electronically filed tax returns in this country. And luckily, I'm part of a 12-person CPA and enrolled agent committee or a customer council where they get us together twice a year and they expose us to a lot of different things. And I had the opportunity to go to Washington, D.C. just in May, met with 4 Congress people, met with one of the heads of the IRS, met with the head of the American Institute of CPAs. And the point is that all of this tax reform is politics and how it's going to affect things and how we can adjust your tax plan. We have to take all the stuff we've been given and figure out how it best affects you. And a lot of the interpretation of the reform is still yet to be determined. We have a midterm election coming here in November, so we're not going to have a lot of what we call a technical correction. So if there's something vague, we don't know how it's going to get enforced. I'm going to use an example that if you have children and you leave them with a babysitter and you tell the babysitter, okay, well, I want them to go to bed at a decent time. Now, to your 18, 19-year-old babysitter, a decent bedtime might be different from your bedtime, right? And that's what the tax reform is. I want you to go to bed at a decent bedtime. Well, what is that? So we have to interpret that. We have to discuss that with our clients and determine what stance we're going to take and how we're going to utilize different entities and such. So, 1986, yes, I had a hairdo then. This is the largest tax system change since 1986, and I just thought, to get an idea of how long ago that was, all this, I mean, come on, the Mets won the World Series. I'm a Tigers fan, but, you know. The Mets won the World Series, and all these cool movies were out. So, yeah. Yeah, I know. Ferris Bueller was out. The political theme was to make taxes easier, okay? To make taxes easier. That was accomplished in some respects when it comes to corporate tax return and regular tax returns. What the heck does regular tax returns mean? That means people that maybe don't own homes, they don't itemize their deductions, they don't have a business, they have a white picket fence, 2.5 kids, a dog, and they, have no mortgage payment. So for those people, things got a lot easier. For people with corporations, what are called C corporations, they got a lot easier. But for self-employed people and everyone else, they got much more complicated, which is kind of cool. It makes it fun for us. Most of the changes take effect January of this year, and they're set to expire at the end of 2025, which seems like forever from now. So that's the time frame that could get extended. One thing to consider, not necessarily for our Tennessee friends here, but for a lot of our clients in other states, is state tax conformity. What does that mean? That means do you live in a state that has an income tax? And if that state has an income tax, is that state going to honor what we're going to get into is what's called a 199A deduction for small businesses? Is that state going to honor that you don't have any exemptions? Or is that state going to honor the depreciation rules that the federal government's laid out for when you purchase fixed assets? That's a state-by-state issue. And if you're a real estate investor, if you have investments in other states, that's something to consider. In Tennessee, really, most of the people here greatly benefited from the tax reform. I would say what we've done is for all of our clients, when we do their 2018 or their 17 tax return, we run a side-by-side and say, what does your tax return look like under tax reform with the same numbers? We're at about a 95% tax decrease for our clients. But in some states like New York, the highly taxed states, California, the tax reform is really actually going to boost a lot of state revenues because it's depending on the state tax conformity and what deductions they're going to allow. Since there's going to be a change to a lot of itemized deductions. So we're going to get into that a little bit. So I know I talked about C Corps. I'm not going to spend a ton of time on this. A C corporation is the type of entity you have when the profit and loss does not flow on your personal tax return. C corporations, much like individuals, had a graduated tax system, meaning for a certain amount of income, this was the tax rate. So for the first $50,000 worth of income, the C Corp tax rate was only 15% on the federal level. And then it went up to 25%, 28%, and went up and up and up. What tax reform did is it made things a lot easier. It said, okay, for any C Corp profit, scrap the graduated tax rates, and we're just going to do a 21% flat tax. Now, interestingly enough, for the small C Corps that only had $20,000 worth of net income at a 15% rate, that tax rate actually went up. But for most of us, this is a big win for clients with C Corps. This is a win if you're in a situation where you have an entity that's producing a significant amount of income and you want to retain that income. You do not need to take that income out and pay taxes on it personally, because the vast majority of people here, and at least in our client base, pay a higher tax than 21%, or at least in what we call a marginal tax rate of higher than 21%. Also, some of you might have heard there's different methods of accounting. One's called accrual, one's called cash, and then there's different hybrid models. All individuals are cash basis taxpayers, and on the C Corp level, what this means is that if you now, they raise the bar as far as if you're $25 million or less, you can be a cash basis taxpayer. Again, this really, I'm assuming, and I hate to make assumptions, it's will not pertain to too many people in today's audience. If you do have a C corporation, please let us know, and we're happy to dive deeper into that. Capital expenditure recovery, that's a fancy way of saying depreciation. Now, whenever we talk about depreciation with our real estate clients, they start getting the shakes because they're like, the whole point of this is to appreciate in value. What depreciation is it's a way for you to recover the costs that you put into a property. That's all it is. And depending on those costs, depending on what you acquire and what those costs represent, that's how quickly you can deduct that amount that you put in. Now, in some foreign countries, you don't even take a depreciation deduction. Here, for single-family residences, it's a 27.5-year depreciation. So for simple math, if you bought a $54,000 condo, okay, because there's no land, you will get approximately $2,000 of a depreciation deduction per year. And for corporations, the depreciation deduction was broadened, for lack of a better term, and you can depreciate things quicker, which means you have less tax to pay. Okay, so for individuals, what we've done is, like I said, we've identified a lot of different items. Those items are on the right-hand side. We're going to drop into each one for about 1 minute. We felt the easiest thing to do would be to let you know, hey, what was the rule currently? And then what is the rule now? Just so you can get an idea of how it affected you in the past. And January 1st, 2018, what does it look like moving forward? 529 college savings plans, most of you are familiar with that. The big change for 529 plans is that you can now take up to $10,000 a year out of the plan and use it for elementary or high school if your children are attending a private high school, which is nice. Now, and 529 plans work similar to Roth IRAs, where you don't really get a deduction when you put money in, at least on the federal tax return, and it grows tax-free as long as you use it for a qualified distribution. Some states do have a deduction for 529 plan contributions, but that's just something to consider. We have a lot of clients that come to us, and maybe they have children in private schools, and they want to access those monies. This is a huge one. The ACA individual mandate, AKA the Obamacare penalty. If you don't have an affordable Obama-qualified health insurance plan, you are paying a penalty on your tax return, unless you met one of the exceptions. This has been repealed, but it's effective January 1st, 2019. So for 2018, this year, you still are required to have a ACA-compliant insurance, but that mandate is gone in 2019. So this is considered by many a big win as far as getting out of that penalty and having a little more freedom on what you're doing with your health insurance or other plans like MediShare and those sort of things. Also for larger employers, that it's very helpful. Okay, for everyone getting divorced soon, let's wrap this up in 2018. So alimony, a big change. And it's funny, as we chuckle, there are CPAs that just specialize in divorce planning. But for alimony, has always been deductible by the person paying it, and it's taxable to the person receiving it. Child care or child support is not deductible or picked up as income. Well, the IRS, figures this. How many people deduct their alimony that pay it? Everyone, right? How many people do you think everyone picks it up as income? Heck no. So they're like, well, wait a second, this is silly. This is not matching. So let's just throw it all out and make it non-deductible. So alimony is not going to be deductible on any divorce finalized in 2019 or later. So again, if you've got problems, let's wrap this up and move on. Yeah, or wait. Oh yeah, if you're going to receive alimony, wait. But no, I'm being facetious, but something to consider. If you already are in a situation where you're paying alimony or receiving alimony, those prior agreements are going to stay in place. Now, this is another thing. How in the heck will the IRS know if you're being paid alimony? There is not a 1099, and that's part of the problem. So when the IRS has trouble figuring out who's doing what, and there's no 1099 involved, they realize this is really too hard to enforce. This is silly. Let's just throw it out. Think about the ACA mandate. A lot of people had trouble with the 1095. People were getting these 1095 forms, and they didn't know what this was. And it was the 1095 form was stating that you had health insurance for these months, and it created a bunch of problems. It created problems especially for clients that were financially strapped, that were getting the Obamacare, and they were getting a supplement and didn't fully understand that if their income went up, they had to pay that supplement back. And then it made your tax return basically a reconciliation of this whole system. And it was a mess. So I don't think many tax preparers are sad that that's going away. So alimony, again, there's some planning involved there. I'll touch just briefly on alternative minimum tax. What AMT is hopefully you don't run into this too much. Actually, I hope you do pay AMT. That means you're making a lot of money and everyone's happy. But there's a minimum amount of tax that you owe based on your income, no matter how much you have in deductions or credits. And that alternative minimum tax the rules are changing so that a lot less people will be affected by it. So I'm not going to get into the nuts and bolts of it. Again, if you leave your card or send us some information or fill out one of the comment cards, we're happy to email you this presentation. And if you run into alternative minimum tax, let us know and we could talk about that in more detail. But it's going to affect a lot less people. The child tax credit. This is on your personal return. It was $1,000 per child based on age and based on income. This is a significant win for the higher wage earners, that they're going to receive this credit that they didn't receive before. So now, just pointing it real quick, so this credit phased out for married couples at $110,000 previously. Now it starts phasing out at $200,000 of adjusted gross income. So many people that weren't getting a child tax credit will now get the child tax credit. And now it's up to $2,000. So when we're looking at our side-by-side projections for clients, we're realizing that now a lot of people that weren't eligible are going to get this, and we can reduce their quarterly tax payments, which puts more money in their pocket throughout the year to do other activities. So estate tax, kind of like alternative minimum tax. The estate tax exemption doubled, which means that a lot less people are affected by it. What the estate tax is, and we could have an hour presentation on that, and half of you will be so bored you'll need your estate tax returns done. But the estate tax said is, if someone dies with a certain amount of assets, there's a tax just to pass those assets on to their beneficiaries. That threshold was about $5.5 million. It now doubled to 11. So in theory, a married couple can have $22 million worth of assets now, and their beneficiaries can inherit that. And I'm still waiting for my rich uncle to come up from somewhere, but that's all right. I'll keep working, I guess. But they can pass away, and that $22 million worth of assets can just go right into the beneficiary names without any tax being paid. Now, if those assets include IRAs or annuities or anything that is a pre-tax asset, there might be a tax owed on the distribution from that. But what the estate tax has done is it's now really shaved down who it affects. And it affects planning as well. That takes the burden off things. Big one here. Primary home sale, and I put a little star. See, if you're sleeping, you're going to wake up now with the star. When the House and the Senate put together their proposals, there was a difference of opinion on your primary home sale gain. And one of the proposals was you had to stay there for 5 out of an 8-year window. And I believe that was the Senate's, and I'm going to tell you why in a second. The House has said, no, 2 out of 5 is good. Why? Well, what's the term for a House of Representative member? Exactly. What's the term for a senator? 6 years. So now we know why the Senate wanted 5 out of 8. This is that 2-year term is the reason this rule really exists, which is called Section 121. So as long as a residence has been your primary residence, this is an old rule, for 2 out of the last 5 years, it doesn't have to be a continuous 2 years, it's a 5-year look back and seeing how many years you've lived there, you can exclude the gain up to $500,000 of gain, not sale price, if you're married, and $250,000 if you're a single taxpayer. If you have mixed use, then we need to just talk, right? Get with a CPA or an enrolled agent. If you rented your house out for a year out of the 5 years, if you, moved away or if you have an unforeseen circumstance that occurs and you can't stay there the full 2 years, there are some exceptions. So this one was on the chopping block, and I've looked at a lot of other presentations, and some of the presentations were actually incorrect in saying that the 5 out of 8 year rule existed, but there's actually no change to this, which is a huge win. So the National Association of Realtors must have been on Capitol Hill just pounding them with some money, because this is a huge win for homeowners. This is a huge win for the real estate industry. This is why people that are builders seem to move every 2 years, right? You can, if you're willing to move every 2 to 3 years, you can make a lot of tax-free money. So this stayed intact. So I was happy to see that, just for people in general. Medical expenses, hopefully not many people itemize their medical expenses. If you're a business and you have a lot of out-of-pocket medical expenses, there are some tools such as health savings accounts and some Section 105 plans. There's some tools to make those tax deductible, but in general, the tax reform made it that only you can deduct anything over 7.5% of your medical expenses if you itemize your deductions. Out of probably, I think we did 3,000 tax returns last year, we probably saw 40 that this would really affect that actually itemize and have that amount of medical expenses. So 7.5, if you have a lot of medical expenses, that might affect you. So this one here, miscellaneous itemized deductions. A lot of those were taken away. And a lot of people out there hear noise from social media, from newspapers, saying, well, my deductions are getting taken away. And this is ridiculous. Well, this is part of tax reform simplification. So tax prep fees, you cannot deduct anymore as a personal deduction. You absolutely still can take them on your business schedule, what's called a Schedule C or Schedule E. Work-related expenses. So if you are a pharmaceutical sales rep and you drive 30,000 miles a year and allegedly no one reimburses you for that, you could deduct that. Well, now that deduction's gone. So a lot of the deductions, which are miscellaneous itemized deductions, or we call 2106 unreimbursed employee business expenses, have gone away. Investment fees paid to financial advisors are not deductible either. So that might change how you invest your portfolio now. You might go change the type of funds and maybe pay those expenses through your funds instead of a fee. You might, or it might not change anything. We always say, don't let the tax tail wag the dog, right? It's an important part of the body, but you need to do what you need to do. And like I said before, even though these deductions have been taken away, 95% of our clients are still paying less tax. So don't get too bent out of shape about losing a deduction. All right, now this has been a hot topic, right? Mortgage and home equity loan interest. This is always a doozy. The main change is this. The slide will drop down, but new homeowners now can deduct up to $750,000 worth of mortgage interest instead of the $1 million limit when we're talking about primary residences. We're not talking about your rental portfolios, your commercial loans, anything that's going on what we call Schedule E, Schedule C. This is strictly personal mortgages or a vacation rent if you throw in a vacation rental. Well, if it's a vacation rental, then it's a rental property, but on personal mortgages. So obviously the government thinks if you have a mortgage over $750,000, you're rich and they have no sympathy for you or whatever. So what happened is $750 was a compromise. The House wanted one thing, the Senate wanted another thing, and they said, fine, cut it in the middle. Let's call it $750,000 on your principal home. All right? Let me back up real quick because part of what we need to consider is that if you had a mortgage that was that you already had for more than $750,000, you could still deduct it. And then here's the other problem. Now let's think about this. You all get the 1098 form at the end of the year that has your mortgage interest, right? How many of those forms say what your balance is? Not many. I've started seeing a couple of them. So one thing I think that's going to happen is the IRS is probably going to mandate that the lenders put the mortgage balance on the 1098 form. Because how in the heck do they know what the balance was at the end of the year? I mean, of course, if you get audited, they're going to find that out. But it's so I think that there's going to be a change to that form, and just something to consider. I want to go back to this just because it's so important for this group. There was some ambiguity about HELOC interest. Okay. Couple things. HELOC interest is deductible if you are using it to acquire, improve your primary residence. What if I get a HELOC and I go buy a rental property with it? Good question, and we're going to talk about that later. So we got to give you a little tease, but it's still there are some strategies for deducting that. But moving expenses, I started this one also because a lot of people in the audience are in the real estate business. They have clients that are moving, especially to this beautiful Middle Tennessee area. But the new bill does suspend the moving expense. So again, when I said this is a political theme, how many people do you think were overinflating their moving expenses? A lot of people. And there was also a rule that said you have to move, I think it was 60 miles away from your previous residence, or it was somewhere in that range to be deductible. How many people? So obviously people were abusing this, and they said, we're going to get rid of the moving expenses. There's an exception for people in the armed forces, which I think is great to have that for them. So moving expenses won't be deductible anymore. I guess the U-Haul Political Action Committee wasn't strong enough to keep that going. Personal exemptions, this is another one where each person on your tax return, you're given a personal exemption, meaning that amount of money was deducted from your taxable income. It did get phased out for higher income taxpayers, and basically that went bye-bye. Now, again, for most of our clients that are higher income, they were phased out of the personal exemptions anyway, and even though this was taken away, 95% are still paying less in tax. So this is part of the simplification. Part of the reason I think personal exemptions were taken out was that there are a lot of issues when you have parents that don't file together. They could be married jointly. They could never have been married. They could be divorced. And figuring out who in the heck is supposed to be claiming these children as dependents is a nightmare. Because the IRS doesn't know. It comes down to the divorce decree, the separation agreement, and that never gets filed with any type of government entity other than maybe the county. So a lot of times when the enforcement's tough, they're just going to toss out the deduction. Standard deduction, this is another one that affects a lot of people that own property. The standard deduction doubled, which means that people that itemize their deductions, meaning they write off their mortgage interest, property taxes, charitable contributions, tithes, work-related expenses. Now that the standard deduction doubled, a lot of those deductions won't add up to more than the standard deduction, so it'll be easier to just do the standard deduction for a lot of those people. So again, for Susie and Joey, white picket fence couple with the basic, straight, easy tax return, things did get easier, and actually I'm happy for those people because they're not in our ecosystem, and they shouldn't have to spend tons of money and time and energy worrying about filing their taxes. If it's a straightforward situation, then it should be easier for them. So married couples filing jointly now have a $24,000 standard deduction. Standard deduction is just an amount that comes off your income before you pay tax. SALT, yes, I know, all the acronyms that us geeky accountants like to use. State and local taxation. This is something that's really not affecting Tennessee very much, but as an itemized deduction, your state and local taxes, which is your state income tax and property taxes, got capped at $10,000. Now, for residents of Tennessee, again, we don't have a state income tax. Our property taxes are very low. Now, no one start throwing your coffee or anything, but in general, when you look at the United States and in the areas on the coast, our property taxes are extremely low. So the $10,000 limit doesn't affect tons and tons of people. But when you live in California and you have a 9.5% tax and your income is $200,000 a year, that's a $20,000 deduction that's gone now. So this really is, like I said, for the people here in Tennessee, this is not a big deal. But for people in high income tax states, this is a huge issue. Student loan debt discharge is basically saying that now if you become disabled or if you pass away, if your debt's discharged due to one of those circumstances, it's not taxable. So we're not going to hit that. So tax brackets and income taxes. I'm going to show you a couple different brackets just to give you an idea of the differences between last year and this year, but we're not going to sit here and look at brackets and do list radio or anything. At the end of the presentation, there are links that'll take you directly to all the tax brackets, both new and old. But essentially, let me just show you because a couple quick ones here. So for a single taxpayer, on the left was the old bracket, on the right's the new bracket. We still have the 10% tax rate, but you can see that if you are at $200,000, your marginal or $150,000 of taxable income, you're at a 24% deduction rate, where you used to be at 28%. So in general, tax rates are about 3 to 5% less than they were before, in general. And it depends on where you fall on these. This is the married filing joint. But again, all these rates and all these brackets there's a hyperlink at the end of this presentation that if you really get insomnia and bored at night, you can start looking at these brackets. Now, small business, self-employed, and pass-through entities. This is really the biggest change and the most complicated part of the tax reform. We did put a hyperlink at the end of the presentation for you to go in and to put in your information, and it'll calculate what additional deduction that you get if you are self-employed, a small business, or a pass-through entity. If you have any type of business activity that flows on your personal tax return, you fit into this category. So if you own rental properties, you're a flow-through. If you're a sole proprietor, a single-member LLC, an S corporation, those are all pass-through entities, or a member of a partnership. There is something called the domestic production activities deduction. I'm just going to skip that for now, but that was repealed. It's very rare, unless you were doing a lot of building construction and that sort of stuff. It was replaced by something called the Section 199A deduction, which we're going to talk about. I stopped here because something that really affects you and something that's been out there in the news media was the elimination of the 1031 exchange. 1031 exchanges were eliminated except for real property transactions. So for any real estate folks, you can still do 1031 exchanges. For anyone that doesn't know what a 1031 exchange is, that is a like-kind exchange where you're selling a property at a high profit and you're investing it into another property and deferring any taxable gain. So that was a huge win. I was very excited to see those keep going. If you have a loss in a year, let's say you have a couple businesses and you lose money, though you have what's called a net operating loss. Those net operating losses, we used to be able to carry them back or carry them forward. Now we can only carry them forward, and we only get an 80% deduction on that net operating loss. I hope that no one in the room has an NOL, but sometimes that happens. We saw that a lot in the late 2010, like 08, 09, 10, when you had people just getting destroyed in the real estate business by losing a lot of money on their projects and properties. Most of those net operating losses have been utilized by now. I know this is a bummer. Business entertainment deduction was eliminated. That you used to get a 50% deduction for business entertainment and meals. Now you just get the 50% on meals. So you might want to think about how you're going to do your entertainment. Do you wrap it around an educational? This is a gray area. Do you go to a sounds game, rent out a suite, and have someone like, well, probably someone cooler than me come in and talk about something relevant, and it's an educational opportunity, and you feed people? I don't know. I mean, there's just things to be discussed. I don't think that people are going to stop doing business entertainment, but as a practitioner, we're going to have to divvy up, okay, what's entertainment and what's meals? Obviously, I want it to be meals because you still get a deduction for half of the meals. So you could buy the cake, you could deduct half of it. You cannot deduct the person jumping out of the cake anymore. And now half my revenue's gone. That's why I'm here. Fortunately, I didn't charge by the pound. So this, as I discussed, the Section 199A deduction was created. All right, this is the biggest coup of the tax reform. This is a special deduction for business owners of a pass-through entity. And like I want to reiterate, even if you have a W-2 job, if you have income from rental properties, you have pass-through income. The calculation for your 199A deduction is extremely complex. But because we're so nice to this group, we did put a link at the end of the presentation that you can go in there and check out. The 20% deduction applies to qualified business income. What does that mean? Well, I have to have income to have a deduction. If you have rental properties with losses, then this really doesn't affect you. But you're going to get a 20% additional deduction, potentially, based on your qualified business income. So if you have an S Corp, not that I advise having an S Corp in the state of Tennessee, but let's just live in this world that you have an S Corp maybe. And I mean, it's good to have an S Corp, but it's not always great to keep profit in it due to some tax, franchise and excise tax. But assume you have an S Corp and you have $100,000 worth of profit, you might be eligible for a $20,000 additional federal deduction. There are some limitations, and the calculation's complex, but that's the theory behind the what we call QBI. I already discussed who qualifies as a pass-through entity. And because this can't be too easy for anyone to figure out, the deduction is somewhat limited if you are involved in a specified service business. Well, that's great. What's a specified service? Wouldn't it be nice if the IRS handed out or Congress came out with a technical correction and said, oh, by the way, here's a list of specialized service businesses. But no, this is making sure your kids are in bed at a decent time. What is a specified service business? We do know some things. They don't like accountants. So if you're a doctor, accountant, in general, if your business is based on the reputation of the practitioner solely, then you're a specified service business. So from a real estate perspective, is a real estate agent a specified service business? Yes. So if you're a specified service business, your ability to take this Section 199A deduction may be limited based on your income. It doesn't mean you can't take the deduction, but it's going to be based on some other factors involved. Planning-wise, real estate flippers, not a specified service business, right? You're flipping. Real estate agents, specified service business. So planning-wise, I'd rather see more income here than here. So if you're doing your own flip, maybe you don't take a commission on it because you're going to pay less tax on the flip than the commission. Just little things like that we have to consider if you're doing a lot of flipping activities and that sort of stuff. So as I said, the Section 199A deduction is complicated. There's a lot of factors. Adjusted gross income is one of it. Your share of W-2 wages paid. So if you're in a specified service business and you can't take the deduction, but you've employed people, you might be able to take the deduction based on the W-2 wages that you've paid. We don't have the tax forms for 2018 yet, but I'm going to assume that the K-1s that you receive, if you're a member of an S Corp or a partnership, there's going to be a new box there that says share of W-2 wages paid. Because how else are you going to know what the heck your share is of the W-2 wages? And another factor is what profession you are, if you're a specified service business. And one more factor, so unadjusted asset basis. What does that mean in English, please? That means that, let's say you are a specified service business, but you own fixed assets, a commercial building that you operate out of. Whatever the unadjusted basis means, which means the amount you haven't deducted yet. So if you bought it for $1 million and you've depreciated $200,000, your adjusted basis would be $800,000. So it's going to get complicated, and it's going to be based on the fixed assets that you have. So if you have your tax returns from previous years, and just make sure you hold on to those, because those fixed asset schedules that these CPAs seem to give you and no one ever looks at for some reason, they're all of a sudden they actually matter now, because that's going to be your unadjusted basis, and that could play a role in your deduction for Section 199A. Point is, this is a complicated deduction. We're happy to help you out figuring it out and how it affects you. Planning ideas. Let's think about some takeaways. We highlighted some of them that I'm just going to click through them, right? Because I know we're running a little short on time. Cost segregation studies are now much more prevalent. Maybe that would be a great presenter, a cost segregation person. What a cost segregation study means is that it's a study that's performed on real property that takes the personal property portion of the asset and deducts it quicker. So what is that? Like a building like this. A commercial property is, you deduct it over 39 and a half years, but if you got a cost segregation study and you bought it as is, you'd have an engineer come in and say, well, okay, there's windows there, those should be written off over 7 years. The blinds, 7 years. The cement outside, 15 years. The roof is worth this. And they break down each asset class, and they allow you to accelerate the deduction. The other cool thing is if you've owned the building for X amount of years and you could have done the cost seg study 5 years ago, you actually can pick up a deduction for all that should have been deducted back from there. Quick example that just occurred this month. One of our clients in our Orlando office has $1 million strip mall. We picked up a $256,000 immediate deduction for him doing a cost segregation study. That's like $70,000 in his pocket. So we have to look at the asset, we have to look at the use and figure out if it's available. But with the new depreciation rules, and the cost segregation studies are going to make more sense. Depending on state tax, again, we're in Tennessee, so the S Corp doesn't always make sense, but for a lot of states, making an S Corp election makes sense because of the qualified business income deduction. Now married taxpayers, it might be more advantageous for them to file separately now due to the tax rate schedules, and especially if one of the spouses is self-employed and the other one is not self-employed but has a significant amount of income. Due to the qualified business deduction, you might want to file separately. For the tax returns we do, we do an analysis on every tax return. Hey, is it better to file separately or jointly? I'd love to say it takes us a long time, but it's really clicking a couple buttons. And the software runs the numbers, but then we would change the variables. But that's something to consider if separately might not be more prevalent now. We talked about the C Corp, so if you have a mature company that's retaining earnings, if at a flat tax rate of 21%, C Corps might become more prevalent. Again, S Corps, C Corps, cost segregation studies, these are just tools in your toolbox, okay? They're taken out when you need to use them. And as long as you're working with people that know what they're doing, they're going to know what tools to help you accomplish what you need to do. But C Corps are going to be more prevalent if you want to retain your earnings at the 21% rate. Roth IRA conversions are probably going to be more prevalent. Roth IRA conversion means you're taking money out of a traditional IRA, you're converting it to a Roth. Even if you're not 59 and a half, you don't have to pay the 10% early distribution penalty, and you pay tax on that Roth conversion. Once the money's in the Roth, it's not going to be taxed again. Especially for flippers, something to consider might be some of your flips doing them in a Roth IRA, because then you don't have to pay tax on the flip. So another great, something to check out are we talk about different types of ways to own real estate. You can own real estate in a self-directed Roth IRA, and that might, at the tax rates that we're at right now, it might make more sense to start accelerating income. So what we help people do is we either accelerate income, or decelerate income for some people, accelerate deductions or decelerate deductions. We're trying to figure out what's best for each client. So let's say you were a highly paid W-2 person, you just made the decision this year, you're going to get into real estate and you're going to start buying rental properties, your income's probably not going to be that high this year. That might be a good opportunity with tax rates low to do a Roth conversion. Let's get that money out of the traditional IRAs and start growing tax-free in your Roth. We have an opportunity with tax reform to enjoy low tax rates. We have, in general, the country is aging, we have a lot of baby boomers, and all of us want to keep at least the standard of living that we have now. And the only way that we're going to be able to do that and have our country pay back its debt is by increasing taxes over the next 20 to 30 years, realistically. So that's why I just feel like this opportunity we have now with tax reform is a way to do a lot more planning. And one of the opportunities is, like I said, is the Roth conversion. And it's not good for everybody. I know we talked about the using 529 plans, the 10T election, extremely important for real estate investors. In fact, I know people in the audience and on Facebook Live that we do this election. But the 10T election, if you have insomnia, look it up. It allows you to take mortgage interest that should be deducted on a primary residence, and if the funds are sourced to an investment property, you can deduct it as investment interest. So again, taking things from what would be on Schedule A, which might be phased out, onto Schedule E and Schedule C. Example, I have a HELOC, I acquire 2 rental properties with it. I want to deduct that interest against the rental properties, but the mortgage or the HELOC's on my primary residence. How do I do that? You use the 10T election. So another thing that when you do hundreds and hundreds of tax returns for real estate people, you just learn these things and you figure out when to apply them. So that's an election that you have to do on your tax return every year. And I think that's going to be, I want to just show you the resources and then the resources here. So if you want the brackets, again, we can email this out to you. Just leave your card or leave us your contact information. We're happy to do that. Or email me. I think we passed some cards around. The brackets are there. The tax reform calculator. The second one is really cool. You go in and it's going to calculate what your tax return looks like under tax reform. And the third bullet is specifically for this, if you're self-employed, for that 199A deduction. So I think if you have any questions, if anyone's still awake, this stuff's pretty exciting, and it is. If you look at it as an opportunity to better your financial situation for the long run, that's what it is. So just build your team around you that you can take advantage of things. So I appreciate everyone's time today, and it's an honor being here. Thank you. Oh.
Don't go anywhere. So, on. All right. Hey, Chris, that was an awesome presentation. I know most of you guys may have been a little bit bored by it, but from a lending standpoint, these two things go hand in hand. what happens in the tax reform law also determines lending practices. And within that, gives investors opportunities to make a lot of money tax-free, a lot of money. The big one is the bonus depreciation. And if you want to touch on that a little bit, because that goes into strategy, into your personal investments and what you're going to look at, and then off of that, what lenders can do to facilitate that is flat out amazing. I mean, we're talking hundreds of thousands of dollars potentially in income you're not going to pay taxes on if you do it right. So I want to touch on that?
Yeah, so bonus depreciation, what that is that's an incentive to acquire fixed assets or make improvements to fixed assets. The bonus depreciation was at 50%. So let's say you buy a new
building.
Yeah, new windows or something. Well, there's a lot of issues as far as what's repair and what's capital improvement. Let's assume you did enough windows, you put in enough windows that it is a capital improvement. The bonus depreciation used to be 50%. That's 100% now. And from a lending standpoint, typically, and Billy can talk about this a little more, that depreciation deduction is added back to your income when they look at your credit worthiness. So in the past, as a practitioner, my objective was to deduct as much as possible. There are certain things called safe harbor limits that anything under $2,500 is immediately deductible as on rental properties and anything like that. The problem is when you take a deduction, when you go go to underwriting, you don't get, that dings you, for lack of a better term. So now that we have the 100% bonus depreciation, we may be more apt to capitalize more and take the 100% deduction, which is the same effect of just deducting it as a repair, but also gives you an add back when you go to lending. Okay, we don't add it back. When you go into underwriting,
We do.
they add back your depreciation, but they won't typically add back other repair expenses.
But it's got to be itemized the right way, which is why you need to work with Chris. So in how this works in reality for investors is you go in and you buy a multifamily, just for example, that is maybe under market rents. You go in and do a lot of capital improvements, raise the rents. We would provide lending on the value add for that, some kind of interest only with repairs. So you're leveraging 80% of the funds. Once it's stabilized, again, stabilized is a very loose term. Once you're basically at market rents and about 95% occupancy, we can turn around and do a cash out refinance based on the new income that you created, paying back all the depreciation, all the money you put into it, plus you're going to get the deductions there.
Right, so the reason real estate's such an attractive asset class because, let me give you an example. Let's say you bought Ford stock for $100 a share. I'm just making numbers up. Or Disney stock for $100 a share. Well, if you don't get to deduct that $100 at all. But if you buy a rental property for $100, which doesn't exist, but you at least get to start deducting the $100 you bought it for immediately, and then offset any income that you get. So that's why it's an attractive thing. And with tax reform, we're allowed to deduct more of the capital improvements and the money put into the property quicker. Great question. So the question is this is great. You get to deduct depreciation, but what happens if you sell the asset? There is a depreciation recapture at 25%, and that's where, so if you took depreciation on something and you sell it, you have to add back that deduction that you took in the past, unless you do a 1031 exchange. So that's where the win is that you can still do the 1031 exchange and take those funds and put it into another property. There are rules and regulations for that, and you'd need to hire what's called a qualified intermediary, and they're going to assist you in that transaction.
Okay. And the second question is, if I buy an HVAC unit, sole proprietor, rental property, so now I could write it off the first year and not over 5 years. I used to have to do 20% a year.
Correct. So if you buy HVAC unit, the question is HVAC unit, or if you buy personal property that you put into a rental, typically you would have to write that off over a period of time. With the bonus depreciation, we can now deduct it quicker.
first year, 1 year?
Yes.
Okay, thanks.
So that's that. So yeah, on the depreciation recapture, that's something you have to consider when you're looking at cost segregation studies. So what a cost segregation study is you're accelerating the depreciation. So as long as I know you're going to hold that property until you pass away or anticipate you doing a 1031 exchange, then the cost segregation study makes sense. Well, thank you very much. And again, it was an honor. Thank you.
Hey, thanks for learning with us today on the show.
We would love to meet you at one of our free monthly meetups in Middle Tennessee.
Hit the thumbs up button if you like the content. Make sure you hit subscribe so you don't miss a thing on this channel.
Check out another awesome investing video here.